Good morning, everyone. Welcome to the weekly Commodities audiocast. I'm your host and guide Ravindra Rao from Kotak Securities Commodities Research Desk. Well, commodities largely traded higher amid supply tightness concerns, while a recovery in dollar on Fed's commitment to tame inflation attempted to limit gains. Weaker manufacturing PMI readings earlier in the week led to hopes that Fed may slow down pace of rate hikes. But a strong NFP print has dashed market hopes of slowdown in monetary tightening from world's major central bankers. Better than expected NFP print and a decline in unemployment rate to 3.5% from 3.7% hinted that the labor market may remain robust. Overall, economic data indicated that the US economy is strong enough to weather higher interest rates. However, a slight slowdown in hiring as compared to the previous reading signaled that the Fed's efforts to cool the economy and reduce inflation were having an effect. Additionally, repeated hawkish commentary by Fed officials added to signs of undeterred Fed's monetary tightening expectations. Comments by Fed officials clearly indicated that the financial market instability does not dissuade them from further rate hikes. Policymakers reiterated that the Fed's priority remains taming inflation and they are not prepared to change course. The American currency rose to weekly high of 112.775 post a labor report extending recovery from 110 levels hit earlier in the week, while US 10-year Treasury yields bounced back to 3.91% from 3.55%. Although the momentum in dollar has waned, it is still holding the resistance turn support near 110 to 110.50, which seems very strong. Although dollar recovered, still it is lower from the highs, and this supported commodities that have managed to hold on to the gains. Commodities, COMEX gold prices made a sharp rebound to $1730.5 ounce from 2.5 year low of 1622 ounce hit earlier in the week. Gold closed the week 1.7% higher, but retreated from higher levels and closed near 1700 as signs of a robust US labor market added to bets of another 75 basis point rate hike from the Fed. Similarly, COMEX silver too slipped from $21 per ounce, but still closed 5% higher near $20 per ounce. Although the strong NFP print has brought back the bears in action, geopolitical tensions and recessionary fears might keep gold supported. For the weeks, bears might try to keep the prices lower as speeches by several Fed members and FOMC meeting minutes likely to reiterate on the tightening stance. Technically, gold seems to have given a false breakdown near $1670 an ounce as a strong piercing line below the breakdown support of 1670 has given bulls the edge. 1740 per ounce remains a strong resistance, which, if taken out on a daily closing, might take prices further higher towards $1780 per ounce. On the flip side, a sustained break below $1670 per ounce might bring back the bears in action. On the MCX front, 51,300 should act as a good support in the active gold contract, followed by 50,800 levels. On the higher side, a closing break above 52,300 would bring back bulls in action. In case of COMEX silver, price is witnessing a throwback after bulls took it higher above the falling trend line. Strong support seems to be near $19.40 per ounce. Till that holds, bulls have an edge. MCX silver should hold strong support near 58,300, whereas a break above the 252-day DMA 62,000 would give the bulls the required edge. On the energies front, both Brent and WTI crude were the outperformers last week. Brent and WTI crude rallied by 12% and 17% respectively, marking the biggest weekly gain since March. WTI closed above 93 per barrel and $93 per barrel, and Brent above $98 per barrel, both 5 weeks high as OPEC Plus announced output cut of 2 million barrels per day, their biggest supply cut since 2020, combined with Russia's threat to massively curb production. Selling in US dollar from higher levels also supported the bull case. For the week, renewed dollar strength might limit the gains in oil prices. Technically, price is approaching. In fact, I would say it is trading near the 250 today DMA resistance. A closing break above $95 per barrel might add more steam to the rally, as the bulls might target $102 per barrel. Till then, a corrective dip towards $90 per barrel, followed by $88 can be ruled out. MCX crude might take resistance near 7,800, whereas support is pegged near 7,200, which is the 250 today DMA. Base metals mostly closed with gains, as limits a decision to restrict new deliveries of the metals from some Russian companies added to the tightness concerns. LME copper closed 1.3% lower on global growth worries, while zinc closed flat, and aluminium 5% higher on European supply cuts. Lead gained the most by 7%, as Nysta's Port Perry-led smelter in Australia with a capacity of 160,000 tons announced shutdown for 55 days. On the price action, MCX copper might trade with positive bias until 640 holds on closing, as it is the right shoulder support of an inverse HNS. A break and close below 640 would indicate continuing weakness, as the bears might target 630 in that scenario. Both MCX zinc and aluminium have witnessed selling pressure at the end of previous week. As However, it might get support at lower levels near 268 and 198 respectively. To conclude, commodities are likely to trend sideways to lower this week, as dollar may extend a recovery on increased prospects of a hefty rate hike, while US retail sales and inflation data next week will be watched closely for more clues on the economy. Besides, increased volatility is expected with a return of China from a Golden Week holiday. Also, risk appetite may be limited, as IMF MD said they will downgrade 2023 global growth forecast from 2.9% and warned of a darkening outlook for the global economy, given the shocks caused by COVID-19 pandemic, Russia's invasion of Ukraine, and climate disaster. With that, I'm signing off. Just watch out for the crucial inflation data this week, and also the minutes from the Fed meetings. Good luck and trade safe.